Hello. People invest in the stock market because they want to earn money, but very often they end up losing money. Things would be better for them if they had asked this simple question: how can I lose money in the stock market? I know that this is not the most exciting question to ask, especially when you're interested to earn money. But by answering this question and taking care of possible losses or disaster is the way to have those huge earnings. Uh, so if you want to earn money and not to lose money, listen carefully. Those are the ways that you can lose money in the stock market. So let's start with the most obvious. You buy a company and it goes out of business, or the business significantly deteriorates. It's like you have bought a machine to produce something and the machine breaks down. So even if you have bought it cheap, it doesn't have value anymore. So you have lost your money in a way. You have lost the money that you have given. It's not the most common way that people lose money in the stock market, especially sensible people that they are aware of it. Let's present a true story. In properties, we have the rent. The equivalent in stocks are the profits, the earnings. So we have Superdry that at that point earns more than 50 million per year. So it's reasonable for investors to give this market value that is above 1 billion. So investors buy a business, they give this amount of money, more than 1 billion, because this business can generate, here you see the blue line, more than 50 million in profits. The problem with equities is that we don't have a rent that stays the same. So here in Superdry, we have the earnings collapsing and then turn to losses. Investors adjust the price that they buy and sell the business, and they give this little amount. I don't know if they're right or wrong, but they believe, the market believes, that probably the business won't survive. If it survives, yes, the price could return back, because if the company turns around and is able to give this amount of profits again, of course, investors won't give just 100 million for a business that earns 50 million per year. They will adjust the price. But as the things are now, it's very possible that the company will get bust. And if the company gets bust, the person that paid more than 1 billion to acquire this business gets nothing. He has lost his money. This is not the most common way that you can lose money. The most common way is by overpaying. Imagine that you have a property that gives you £2,000 per month, and you pay for this property £10 million. If you pay £10 million, you have lost your money. So what happens in the stock market is that when we have bubbly conditions, we have this type of prices, and people feel confident because they see the prices going up, and that makes them feel confident that they are great investors. But if you buy a property that gives a little rent for 10 million, you are a fool, and you feel confident because there is a greater fool than you that gives 15 million, then a greater fool that gives 20 million, and that goes on, and that creates a bubble. But when you have a crash or something, everything disappears, and all this fake value goes away. So most people lose money sometimes in good companies with prospects, but when they pay ridiculous prices. Let's take a random true example, the BT Group here. If we see the history, earns about 1.5, 2 billion per year from a market value of 25 billion, which seems reasonable for 2 billion earnings. The stock is climbing. and the price goes to 40 billion, it goes to 50 billion, it goes to 60 billion, and here the person feels so clever, and he feels as a great investor that has tripled his money, and then here he puts maybe all his money thinking that it's so easy. But you see, unfortunately, in the end, the price returns to the real value, and the person that bought this stupid price, of course, he got a big loss. Now, the same people that overpay are those that go and sell in panic when there is a crash. So that way, the property that they bought for 10 million, they go and sell it for just 100,000. So they kill every value that they have in their hands, and they lose for a second time. For this person, think of the psychological pressure. He's losing money, and this is not a process that happens in 1 or 2 or 3 months. It's something that takes time. So it's something that makes him feel that he is always losing money and losing money. So you see, in the end, and probably near the worst point, he cannot stand this situation. The price is just 13 billion, which is very low, but the person cannot stand the fall of the stock and goes and sell here and realize some loss. Even worse, if we go in 2008, we see that the stock price goes to this amount, just 6 billion. It's like you own a house and the price goes to just 60,000, and because you cannot stand the falling price, you go and sell. And the problem here is that doesn't last just for 2 or 3 months, so it's really difficult for the person to withstand this thing if he doesn't have the right philosophy, if he doesn't think of the true earnings and the dividends that come from the company. It's very, very difficult to withstand it because he thinks that every month he's losing money, so he cannot stand it and go and sell at the worst point. Of course, in retrospect, it's easy to see the story, and also we know that the company finally survived. Probably it will survive because it's a strategic company, it's a big company, but in retrospect is always easy. But the point is that the person that sold at this very, very low price, he just realized some loss, because probably the real value of the company, maybe it's around here. So far we have seen these ways that you can lose money. You buy this business for this price, but the business collapses to this value, so you lose this value. The other one is that you have this business, but you have paid this price, and because of that you lose this value. And the third one is that you go and sell the business in a very, very low price, and you destroy this value, you go and realize a loss. If you do those mistakes, you'll end up losing a lot of money, but most of the time it's a combination of those mistakes. I would say that the two last mistakes are the most common, like buying in very expensive prices and then selling in panic. Now let's go to the portfolio side. When you are an equity investor, you don't own just one stock, you own a portfolio of stocks, and if you don't, you should. And if you don't, you make the fourth mistake, which is that you don't diversify, which can be fatal for your wealth, because this is the mistake that it's dangerous to destroy all your wealth. I mean that if you are careful and you're aware of the things that we said earlier. Even if you make few mistakes, okay, you may underperform, but long term you won't do that badly. But if you don't diversify, even if you make less mistakes, this one mistake can kill your wealth. So this is very serious. This is how people lose all their money. This is how people get destroyed in the stock market when they don't diversify. So this is really, really serious. A very characteristic example is the investors in Greek banks. They were considered to be safe investments, but banks are very aggressive investments because they are leveraged businesses. I won't explain more right now, but for this reason, they were those that affected by the Greek crisis. So you see that anyway, for the past 10 years, the Greek general index has lost more than 50% of its value. But people that they did not diversify and just bought 2 or 3 banks, I mean, companies in the same sector, you see that they lost all their money, which is very sad because there were people that they were considering that banks were safe. So people that they were conservative investors lost everything just because they invested just in one sector. So it's very important to diversify among different sectors, countries, or asset classes. And finally, we have averaging down. Averaging down is not bad generally, especially when you have strong conviction. So averaging down is that you buy a stock and then the price goes down. So you think that now it's a greater bargain and you add more, you buy more at a lower price. For the times that you are right, this can work perfectly. But for the one time that you are wrong and you have strong conviction, that can cost you a lot. Because when a company, let's say, goes bankrupt, the stock price can drop 90%, then again 90%, then again 90%. If you have strong conviction, if you think that the market is wrong, this one time that you make this mistake, if you add more and more and more money without realizing it, you can spend a large part of your portfolio value, and this can be very dangerous. So what you can do is to put a limit when you do averaging down. So if you have invested 1,000, then the stock goes down, you reevaluate the situation, and if you have strong conviction, you add 500, then you can add 200, but you put a limit because this can destroy a lot of the value of your portfolio without realizing it. I will use Guru Focus again. You can try it for free for a few days. See the description below. Just to explain the concept, here we have the most famous Greek bank, the National Bank of Greece. A person here believes that probably the stock went down, and he is wrong and believes that there is value there, and he goes and buys more. So he diversifies, but he increases his position in this losing stock. Then after 1-2 years, oh, the price goes further down and he continues pouring money, another 10% of his portfolio. Then he continues pouring money, another 10% of his portfolio. So he always diversifies among different stocks, but he always buy more and more of national bank. So in the end, even if he diversifies, he has spent a large amount in this single stock, and you don't realize that, because the stock is never a big part of your portfolio, but through the years you have destroyed a lot of value without realizing it. So on the portfolio side, we have the diversification. You have to diversify well, and then when or if you do averaging down, you have to put a limit there. Now, whatever I have said is about investors, true investors, that they think that they buy businesses when they buy equities, stocks. For people that they do trading or other things, I don't consider them as investing. Okay, they have the right to do it, but what I say probably doesn't apply to them. I'm talking about true investors, that they buy businesses and they have a long-term view. Have you lost money in the stock market? Tell us your stories in the comments below, and don't forget to like the video and subscribe to the channel. Bye.